Navigating global investments, the crucial role of exchange rates in international portfolios. Introduction. In the era of globalization, where borders are increasingly porous and markets interconnected, the role of exchange rates in international investment portfolios is a critical facet that investors cannot afford to overlook. These rates, the relative values of one currency against another, exert a profound influence on the returns and risk profiles of investments spanning the globe. Unraveling the complexities of exchange rates is essential for investors seeking to craft resilient and diversified international portfolios. The Forex Symphony. Exchange rates, often referred to as the heartbeat of the foreign exchange, Forex, market, are dynamic and subject to a myriad of factors. The forces shaping exchange rates range from economic indicators and interest rates to geopolitical events and market sentiment. Understanding this intricate symphony is fundamental to appreciating the impact of exchange rates on international investment portfolios. Currency diversification as a risk management tool. One of the primary roles of exchange rates in international portfolios is their function as a risk management tool through currency diversification. When constructing a portfolio that spans multiple countries, investors are exposed not only to the performance of the underlying assets but also to currency risk. Fluctuations in exchange rates can either amplify or mitigate returns, depending on the direction of currency movements. For instance, consider a U.S. investor holding European stocks denominated in euros. If the euro weakens against the U.S. dollar, the investor may experience a decrease in the value of their European holdings when converted back into dollars. On the flip side, if the euro strengthens, the investor stands to gain. By strategically diversifying across currencies, investors can potentially offset currency-related losses and enhance the risk-adjusted returns of their portfolios. Impact on investment returns. Exchange rates play a pivotal role in determining the returns of international investments. Currency movements can either act as a tailwind, boosting returns, or as a headwind, constraining performance. Investors must be attuned to the interplay between asset returns and currency fluctuations to make informed decisions. For example, consider a Japanese investor holding U.S. Treasury bonds. If the U.S. dollar strengthens against the Japanese yen, the returns on the U.S. Treasury bonds, when converted back into yen, increase. Conversely, a depreciation of the U.S. dollar would result in lower returns for the Japanese investor. In this way, exchange rate movements can significantly influence the attractiveness of international assets to investors from different countries. Interest rates differentials and carry trade strategies. The divergence in interest rates between countries adds another layer of complexity to the role of exchange rates in international portfolios. Investors often engage in carry trade strategies, capitalizing on interest rate differentials to enhance returns. In a carry trade, investors borrow in a low interest rate currency and invest in a high interest rate currency, aiming to profit from the interest rate spread. For instance, if the interest rate in country A is higher than that in country B, investors may borrow in the currency of country B and invest in the currency of country A. While this strategy can amplify returns, it also exposes investors to currency risk. Changes in exchange rates can impact the profitability of carry trades, underscoring the need for a nuanced understanding of interest rate differentials and their implications for currency movements. Hedging strategies and mitigating currency risk. Given the inherent volatility in exchange rates, investors often turn to hedging strategies to mitigate currency risk in international portfolios. currency hedging involves using financial instruments, such as forward contracts or options, to offset potential losses arising from adverse currency movements. For instance, a U.S. investor with exposure to European stocks might use currency futures to lock in a predetermined exchange rate, protecting against the risk of the euro weakening relative to the US dollar. While hedging can provide a level of certainty, it comes with trade-offs, including costs and the potential foregone benefits if the hedged currency strengthens. Global economic indicators and exchange rates. Exchange rates are closely tied to economic indicators, and changes in these indicators can reverberate through international portfolios. Key economic metrics, such as GDP growth, inflation rates, and trade balances, influence the strength or weakness of a country's currency. Savvy investors monitor these indicators to anticipate potential shifts in exchange rates and adjust their portfolios accordingly. For instance, if a country experiences robust economic growth, it may attract foreign capital, leading to a stronger currency. Conversely, economic challenges or uncertainties can result in a weaker currency. Investors incorporating global economic indicators into their analyses can gain insights into potential currency movements and position their portfolios strategically. Conclusion. In the intricate dance of international investments, exchange rates emerge as a central player, influencing returns, risk profiles, and the overall dynamics of portfolios. Investors navigating the global marketplace must be adept at deciphering the signals embedded in currency movements. Recognizing the interplay between economic factors and exchange rates, and implementing thoughtful strategies to manage currency risk. A well-crafted international portfolio not only considers the performance of underlying assets but also acknowledges the critical role that exchange rates play in shaping the investment landscape. As the global economy continues to evolve, the wise investor remains attuned to the nuances of exchange rates, ensuring a resilient and adaptive approach to international portfolio management.